So let's take a look at the financial markets. I will open up a slide deck. And so our slide's titled The Role of the Financial Markets. Basically what we have here is there are always individuals and organizations who have funds to invest, and individuals and organizations that are in need of borrowing funds or raising funds. These things happen in the financial markets, and there are two very large types of markets: the public financial markets and the corporate financial markets. The public financial markets are basically governments that are in need of borrowing funds. For instance, the city of Quincy, the town of Braintree, the city of Boston, the state of Massachusetts, the state of California, the federal government. These are organizations that typically are in need of raising funds for purposes of education or building roads or financing the building of government centers, things of that nature. Those organizations will issue bonds, and investors might buy those bonds in the public financial markets. The governments, city, state, or federal government cannot sell stocks because they have no equity to sell or to share with a potential investor. They sell bonds. In the corporate financial market, we have organizations like Google and Apple, General Mills, and Exxon. These corporations can raise money in the financial markets either by selling bonds or by issuing stocks. So those are the primary markets. The markets are both domestic or international. The largest marketplace is the New York Stock Exchange, followed by the NASDAQ. So the two large U.S. domestic markets are the largest exchanges, largest marketplaces, but there are very significant marketplaces internationally in London, Shanghai, and around the world. We have international markets. I mentioned already there are corporate and government markets. And then you have the difference between a money market and a capital market. Money markets are markets that issue very short-term, high-quality bonds with maturities of 1 year or less. Those are money markets. Low-yielding, conservative. Capital markets, on the other hand, is where you can find stocks to buy or bonds that have a larger duration or maturity, stretching out beyond a year and all the way to 30 and 50 years if you chose to. So make sure you're aware of the difference between domestic and international markets, corporate and government markets, money and capital markets. This slide we basically already covered in my earlier comments, with the exception that the types of securities found in the money market will include things like commercial paper and certificates of deposit. Capital markets, on the other hand, have securities that stretch out more than a year, and they can be in the form of, typically it's common stock or corporate bonds, as well as government bonds. So let's think the stock and bond market with, in terms of the stock market, there's no holding period, but in terms of corporate and government bonds, we would be dealing with corporate and government bonds that mature at least 1 year out. What's the difference between a primary market and a secondary market? A primary market is that place where an initial public offering occurs. In the recent year, we had Lyft and Uber go to market. And it was the first time that they went from private ownership to trying to raise funds through offering stock. This is called the initial public offering because it's the first time that the stock was available to shareholders on a publicly traded basis. Once shares are made available through an initial public offering, those shares later can be exchanged by others. Let's take, for instance, the Ford Motor Company, which would have gone public probably prior to the Depression, maybe in the 1920s. So its public offering occurred almost 100 years ago, but shares have been trading hands ever since. Shares in Ford Motor Company will change hands today. All of this secondary trading occurs in the secondary market. Apple is now in the secondary market because its initial public offering occurred, I think, in the 1980s. And then as shares change hands, this takes place in the secondary market. So you need to know the difference between the initial public offering or primary market and the secondary market. One of the things the marketplace will do is it will evaluate the level of risk that they feel an organization's stock or bonds has, or the lack of risk or greater stability, and factor in all of these variables in order to set a fair price for the stock or bond. So for instance, if a bond has an extremely high yield, if you were to invest in a bond today that had a yield of 7.5%, which is quite high, you would be paid a large amount of interest for that bond, but it's because the bond is considered risky. So the underlying fundamentals of the company would suggest that the company has a high level of risk. Therefore, when a company with a high level of risk wants to borrow funds, they need to pay a higher interest rate to investors to accept the risk. On the other hand, stock prices can be significantly high because you're purchasing a very stable and profitable company. So it becomes more expensive to buy a very favorable or profitable, for instance, shares in Microsoft at the moment are rather costly, more costly than are the shares of Apple, because Microsoft at the moment is viewed as having greater growth opportunity and future brighter prospects than does Apple, although Apple is stable and will likely to continue to make profits for the foreseeable future. The outlook for Apple is not as bright as the outlook for Microsoft. Therefore, Microsoft shares are going to be more expensive. We'll look at how we value what's expensive and inexpensive in the stock market in a later presentation. But for the moment, we need to be aware that the way securities are priced has to do with the level of risk in the underlying company and relative to the amount of return you might generate by making the investment.